Basics of tax-efficient investing. Introduction. Before diving into the depths of tax efficiency, it's crucial to understand the foundational concepts. Tax-advantaged accounts. Roth IRA. You invest post-tax money, and both growth and withdrawals are tax-free. Ideal for younger investors who anticipate being in a higher tax bracket during retirement. Example. If you expect to earn more in the future, placing high-growth stocks in a Roth IRA ensures the gains aren't taxed upon withdrawal. Traditional IRA. Contributions can be tax-deductible, and the growth is tax-deferred until withdrawal. Example. If you're nearing retirement and in a high tax bracket, using a traditional IRA can reduce your taxable income now. 401k. Primarily offered by employers, these allow for tax-deductible contributions with tax-deferred growth. Example. If your employer matches contributions, it's free money. Always contribute enough to maximize the employer match. Advanced tax efficiency strategies. Introduction. Mastering tax efficiency means knowing where and how to allocate specific assets for maximum growth and minimum tax liability. Optimal fund placement. Taxable accounts. Used for holding tax-efficient funds like index funds or ETFs due to their low turnover. Example. Holding an S&P 500 index fund in a taxable account because it rarely buys or sells stocks and thus incurs fewer capital gains. Tax-advantaged accounts. Best for tax-inefficient funds like bond funds or REITs, which produce regular income. Example. Keeping high-yield bond funds in a traditional IRA so the interest payments, which are taxed as ordinary income, aren't immediately taxable. Real estate and tax breaks. Real estate investment can provide numerous tax advantages. Depreciation. Real estate investors can reduce their taxable income by depreciating the value of their property over time. Example. If you own a rental property valued at $300,000, excluding land, you can deduct $10,909 annually for 27.5 years as a depreciation expense. 1031 exchange. This allows investors to defer capital gains taxes by rolling the proceeds of a property sale into a new property. Example. If you sell a property and make a $50,000 profit, instead of paying capital gains tax, you reinvest that $50,000 into a new property, deferring the taxes. Strategic harvesting and investments. Tax loss harvesting. Offset gains with losses to minimize tax liability. Example. If you gain $10,000 from one stock but lost $4,000 in another, you can sell both and only pay taxes on a $6,000 net gain. High dividend stocks. Ideal for tax-advantaged accounts as dividends can be taxed at a higher rate if held in regular accounts. Example. Placing a high dividend stock like AT&T in a Roth IRA to avoid immediate taxes on the dividends. Tax efficiency is both an art and a science. By understanding these strategies, you're positioning yourself for greater wealth accumulation over the long run.